Hi, this is Sharif Abdu. I'm a senior analyst here at Valuation. I'm joined today by two other senior analysts, Alan House and Charlie Moran. We here at Valuation hope you and your family are staying safe and dealing with this difficult time as best as possible. So today, we're going to provide an update on the COVID-19 situation and its ongoing impact on the economy and the stock market. We will also discuss the actions that Valuation is taking to help our subscribers navigate this still challenging time. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website. That's valueline.com, as well as on our YouTube channel within the next 48 hours. All previous webinars are also posted on our YouTube channel. Also, if you have any questions for us today, please feel free to submit them in the Q&A section of the WebEx sidebar. We will do our best to answer. So before I jump into the heart of the presentation, for those of you that are joining us for the first time, I just want to provide a brief overview of who we are at Valuation. So Valuation is a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Valuation Investment Survey. This is a unique source of financial information, and it's designed to help investors make more informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. We also provide economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much, much more. The service is published weekly. It's created by Valuation's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Now, one thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valuation has no investment banking business with any company, and that includes all the equities under our coverage. Valuation does not execute trades for its subscribers, and therefore we really have no vested interest in whether our subscribers buy, sell, or hold a specific equity. In addition to that, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Again, I just want to stress that if you have any questions about the products or services that we offer or our different tiers of subscriptions, that information can be found at our website. That's valueline.com, or you can call 1-800-VALUE-LINE. Okay, now we're going to discuss the coronavirus, the economy, and the stock market. The following content was prepared by Valuation's economic staff. Okay, I'm just going to read this off for you. The Federal Reserve is closely monitoring the inflation situation. We think next week's respective data on consumer and producer prices may be a watershed moment for the central bank, because if those readings continue to show very large gains, it may force the Fed to act more aggressively on the monetary policy front. This would increase the likelihood of a 50 basis point hike to the benchmark short-term rate at the Fed Open Market Committee, the next committee, which is going to be in May. The first move by the central bank to combat inflation was a 25 basis point increase to the benchmark federal funds rate. And that's spanning a bracket of 0.25% to 0.5%. That took place at the last Fed Open Market Committee meeting. That was in mid-March. Overall, the Fed struck a more hawkish tone, telegraphing the possibility of as many as 7 hikes before year's end. Central bank leaders also have discussed plans to begin reducing the bank's balance sheet. It swelled to nearly $9 trillion as an extended stretch of stimulus measures, including monthly bond buying, flooded the financial system with liquidity at the height of the pandemic, and help to avert a more prolonged COVID-19-driven economic downturn. Treasury market yields are on the rise. The rate on the benchmark 10-year Treasury bond, which was 1.7% on March 1st, recently topped the 2.5% mark. With first quarter earnings season about to kick off, Wall Street will be looking to see if the rising borrowing costs will have a negative effect on the outlook for corporate profits. If company growth projections as a whole are reduced, this may bring increased worries about a slowing U.S. economy and create a slippery slope for the Federal Reserve in its efforts to stabilize prices. In conclusion, bond prices are falling, which is pushing investors back into equities. Technology stocks rallied in late March after the tech-heavy NASDAQ briefly fell into bear market territory earlier this year. However, with inflation stubbornly high and the central bank tightening the monetary reins, those looking to increase their equity market exposure may want to give value-oriented stocks, which tend to perform better in a rising rate environment, a closer look. In general, a well-diversified portfolio of high-quality stocks, including those of the well-capitalized technology companies, may be the winning strategy in what is looking to be a volatile year for equities. Please refer to the inside back cover of our selection and opinion section for our statistically based asset allocation models current reading. So that commentary was prepared by Valueline's economic staff, and I just want to highlight one section from the commentary that I just read. With inflation stubbornly high and the central bank tightening the monetary reins, those looking to increase their equity market exposure may want to give value-oriented stocks, which tend to perform better in a rising rate environment, a closer look. In general, a well-diversified portfolio of high-quality stocks, including those of the well-capitalized technology companies, may be the winning strategy in what is looking to be a volatile year for equities. I just want you to keep that in mind as we move forward. So on that note, Valueline is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, our time-tested ranking systems, and other valuable services. In addition, Valueline provides a great deal of daily content that can help you avoid the pitfalls as well as profit during this volatile time in the stock market. Every business day, senior members of Valueline's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, as well as other sources of data and information that may change our view and investment recommendations for specific stocks. When something noteworthy does cross our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and for shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. So now I'm going to take you to our website, and I will show you how to access it. Once you are signed in, you can head to the dashboard where I am already located. This is the main landing page for subscribers. Under the quick links, we can quickly click on the Supplementary Reports tab. And as you can see, once we get onto the Supplementary Reports section, okay, as you can see, or maybe can't see, under the Supplementary Reports section, what you'll typically see when you go there is that the research department has been busy publishing our updated thoughts on the stocks that we track. And we strongly suggest that subscribers visit this page often. Some individual companies have incurred a lot of debt or sold stock to improve liquidity over the last 2 years, as I'm sure you're all aware, especially those that are dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the changing structure of company balance sheets, Valueline has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter. For those of you that don't know, financial strength along with price stability, which is another proprietary Valueline measure, are the two metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Valueline provides a user guide that can be accessed via the investment education section of our website. Lastly, I think this is a good time to mention that the case for individual stocks is quite strong in favor of broad index funds. Certainly particular industries and sectors will recover more quickly than others during and after this pandemic runs its course. Now, we're going to walk you through the screener, the Valueline screener, and we're going to select one stock to buy right now. So we're going to move over to the screener section. And I just want to touch on the screener just in general. Subscribers have access to 15 preset screens as well as 50 fields that can be selected individually. I should also mention that another 100 or so fields are actually available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUELINE. That's 1-800-VALUELINE. So let's get into the screener. Let's get down to the nitty-gritty here. Market conditions, I'm sure you're all aware, have been very fluid, especially now, and long-term visibility remains clouded. So for today, we're going to focus on equities with superior prospects in the short and intermediate terms. Today, we'll start the screening process by looking at timely industries. So what we want to do is we're going to scroll down to the ranks and ratings section of the screening criteria, and we want to narrow that down from 97 industries that we cover, and we want to focus on the 15 industries that we think have the best year-ahead prospects. So just by applying that individual screen, just that one screen, we've narrowed down our list of potential candidates from 5,700 stocks that are in Valueline's database down to, as you can see on the screen there, 1,369 stocks. So that's a pretty big reduction already. We've gone down from 5,700 down to 1,369. And just in general, when we're applying screens, when we're applying criteria, we want to use kind of a systematic approach. We don't want to just randomly select criteria. You want to have a particular frame of mind. So for, like I said, you know, our approach today is we want to focus on stocks that we believe have very good near-term prospects, stocks that we believe will be superior performers in the next 6 to 12 months. So we're going to stay with that theme of near-term prospects. And now we're going to apply another filter. This time we're going to look at timeliness ranks for individual companies. So we're going to click on timeliness ranks. That's also in the ranks and ratings section. And we're going to look at stocks that are ranked 1 or 2. For people that may not be aware or maybe are new to Valueline, timeliness rank is a proprietary Valueline measure that evaluates a stock's projected price performance in the coming 6 to 12 months. It's a pretty straightforward scale from 1 to 5, with 1 being what we believe are the stocks with the superior or the best near-term prospects. So today we want to focus on stocks with ranks that are 1 or 2. And as we can see that we've already narrowed the list of candidates or potential candidates down even further. We've gone from 1,369 down to just 136. So it's a pretty big reduction. We've whittled down that list to 136. So the next thing we want to look at, the next screen that we want to apply, we're going to stay in the ranks and ratings section over on the sidebar there, and we're going to look at technical rank. Now, whereas timeless ranking system, with the timeless ranking system, we're attempting to quantify the outlook for the equity. Technical score is more focused on the company's operational performance. Okay, so today we're looking at companies with a technical score of 1 or 2. And okay, so now we see that our list of candidates has gone down from 136 to 62. So we've cut it down by more than half. So we're getting there. That's the process. We want to use a systematic approach. We've gone from 5,700 down to about 1,300, down to 136, now down to 62. So the next step that we want to apply is we want to expand our time frame just a little bit. We've gone from the very short term, that is 6 to 12 months. Now we want to expand it to, let's say, the intermediate term. And we're going to look at 18-month investment prospects. So we're going to go up to the company data section, and we've just clicked on the 18-month TPR midpoint. So we want to look at stocks with appreciation potential of 25% or better in the next 18 months. And that's to the midpoint of our price bracket. So we can see that by applying this next screen, we've gone from 62 stocks down to 28. Okay? So now we've looked at appreciation potential. The next thing we want to look at is some balance sheet considerations, right? We've looked at the appreciation potential of these stocks. We've narrowed our list down. Now let's narrow that list down even further. So we're going to scroll back down to the ranks and ratings section, and we're going to apply 2 criteria here. These are 2 closely related criteria. One focused on the quality of the stock, the other focused on the financial position of the company. Now, the first criteria we're going to apply in this section is safety. So we're going to look at stocks with a safety rank of 1 or 2. Just to touch on safety rank, there are loads of risk measures out there, okay? With safety, we're attempting to evaluate the total risk of a stock. And our scale is a pretty easy to understand scale. It's just 1 to 5, with 1 being what we consider the most conservative issues. And one thing I want to emphasize right now is that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. Another positive there is that stocks that are favorably ranked for safety also meaningfully participate in up markets. So it gives you downside protection, but you also get to enjoy the benefits when things are going well. For more information on safety as well as our other ranking systems, we encourage you to take a look at our ranking system guide, which is available free of charge from within the investment education section of our website. So we've got the list down to 5. We're going to double down on another additional level of security. We're going to double down. Right now, we have looked at safety. We're going to look at financial strength. So we're going to look at companies with a financial strength of A+ or A++. These are companies we want to narrow down our list to the strongest companies, right? And now the financial strength scale goes from C to A++ in 9 increments. Okay, so again, we're going to look at stocks with an A+ or an A++, and we've narrowed it down to our 3 finalists for today, which are Alphabet, Intuit, and Lowe's companies. Now, you can make a pretty strong argument for any of our 3 remaining candidates, and investors that are interested in adding new positions should consider any one of them. I think they're all pretty good selections. However, there can only be 1 stock to buy right now for today, and after consulting with a number of our senior analysts, we prefer and recommend Intuit, and the ticker symbol on that is INTU. So we're going to touch on a few basic things about Intuit first. For those of you who may not be familiar, I'm sure most of you are, but just in case, the company provides financial management solutions for small businesses, consumers, as well as accounting professionals. The products that it offers include QuickBooks, which is a very popular bookkeeping software for small and mid-sized businesses. Intuit also offers tax preparation software, TurboTax, which targets the consumer market. It also has professional tax prep offerings, including Pro Series and Lacerte. I hope I'm saying that right. Lacerte. So now we're going to look at our last full-page report, which you can access by clicking on the top right section of the Valuation page there. There you go. Our last full-page report was published in February. And as you can see, if we scroll up to the statistical array, Alan, can you make the page a little larger so maybe people, our participants, can see things a little bit better? That's perfect. That's perfect. Thank you, Alan. So as you can see, if we look at the statistical array, which is the center section of the page, this section includes financial data for the company. Intuit performed relatively well through the pandemic. Sales and share earnings actually expanded 25% and 24% respectively during fiscal 2021. And one big growth driver for the company last year was the acquisition of Credit Karma in December of 2020, which gave its results a big shot in the arm. The integration of that buyer seems to be progressing well, so that augurs well for the future. If we look ahead at fiscal 2022, which is the current fiscal year, we actually expect sales and share earnings to jump another 28% and 20% respectively. Our projections are based on another recent acquisition that Intuit recently completed. That's the buyout of marketing platform maker MailChimp. Another positive for the company is that small business formation is booming. Applications for new businesses continue to exceed record levels. So that's another positive development. Now, if we take a look at some of the quantitative metrics for Intuit, we see that if we look at the top left section of our last full-page report, we see that the safety for the company is a 2. So that's an above-average safety rating. Seems that the company has very good and secure finances. If we look at the bottom right of the page, Alan, if you're able to scroll down there, and we look at that bottom box there, that bottom section, we see that the company's financial strength rating is an A+. So that's a very healthy financial strength rating. We also see that it has very positive scores for price stability, 80 out of 100. Price growth persistence, that's a stellar 95 out of 100, and earnings predictability at 80. If we look at the stock's 18-month appreciation, it's 25% to the midpoint of our 18-month target price range, which is pretty respectable. All told, we think that Intuit is poised for strong results in fiscal 2022 and beyond. And we think that the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle some of your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, I would recommend that you review our latest reports on those individual stocks if you have questions about them. The first few questions were submitted to us prior to this presentation, and at this point, I will hand it off to Alan and Charlie. Guys?
Thank you, Sharif, for the presentation. This is very informative. The first question that came to my attention was about the 18-month target price range, and And, for quite some time, Valueline was, it still is known for its timeliness rank and its 3 to 5 year appreciation potential. The timeliness rank is a measure for the year ahead price performance, basically the next 6 to 12 months, whereas 3 to 5 year appreciation potential is looking at things through a longer lens. So a few years back, probably 4 or 5 years back, we started a metric for the 18-month appreciation potential with a midpoint, based on all the companies under our coverage. So we thought that would be a good indicator for people with an intermediate term time horizon. And as Sharif alluded to, Intuit, has pretty solid 18-month appreciation prospects, and as well as being a timely stock for the year ahead. So, thank you. There was another question that someone alluded to about how often we publish supplementary reports, and Sharif alluded to that earlier. I'll go to that screen now. It's on the main landing, as you can see, the dashboard, and underneath supplementary reports, I'll click on that, and you could see that Valueline updates, supplementary reports every business day. It's not earnings season right now. It's kind of on the cusp of earnings season in a few weeks. But as you can see, there's been a lot of, still 3 or 4 supplementary reports each day. Obviously, if a company reports earnings, we'll write a supplementary report on it. But there's also other noteworthy events, mergers and acquisitions, significant changes in the company structure, things like that. We will write a, report as well. So I just wanted to note that.
Okay, Alan, can you hear me?
Yeah. Hey, Charlie. How you doing?
I'm doing well. I was going to take a couple questions. I'm Charlie Moran, Senior Analyst at Valueline, and there was one from Bruce who, asked about a patent suit that just came down the pike yesterday from a company, from the courts in Southern California, and I guess Intuit was the target of a patent suit regarding its technology, its banking technology. Another company is stating that it is infringed upon them, and I thought it was a good point to, or a good question to make reference to the fact that we are reporting or putting these reports out every 3 months, and when something that is deemed to be important to the stock price and it affects it dramatically within the day, we will write supplementary reports on the subject. Fortunately for Intuit, it doesn't look too damning at this point. However, this was just filed yesterday, I believe. The stock price is up today, but again, we file supplementary reports when there are huge stock price movements in response to news in between the issue dates. Another question was from John, I believe, asking about the operating margin and how that's calculated, and he asked specifically, is that something called EBITDA? And EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization, and essentially that is exactly how we define it. We do take out depreciation and amortization expenses in calculating the operating margin, so it is going to look a little bit higher than other conventional measures, although I think now EBITDA is becoming a much more common benchmark than it had been in the past. As you can see, the operating margin has been in the high 30s in recent years. It's difficult to see how the integration of Credit Karma and MailChimp are going to affect that, but so far it seems as though the margins have not suffered, and they have actually continued to increase their guidance in every quarter following the Credit Karma purchase. They've done quite well in initiating loan growth and credit card growth, and I think that management's going to be very successful in its cross-selling and its ability to leverage its two primary businesses, the consumer and tax division. So I guess other questions, Alan, do you have any there?
Yes. There's an interesting question about someone asked about the what Sharif alluded to at the bottom here, the price stability, the price growth persistence, and the earnings predictability. And I'll touch upon those briefly, each one of those. And the stock's price stability is pretty much, straightforward what it says. It's basically how stable a price is, over its history, and an average stock would probably be right around 50, and like Intuit is 80, so that would be, a quote-unquote a less riskier play compared to other stocks. So a price stability is a good indicator of the volatility of the stock. That we have stocks as low as 5. We have stocks that are 100. So Intuit fares pretty well on that realm. The price growth persistence it's a measure of how well the stock price is growing over time, how persistent it is, so to speak. And once again, Intuit is near the top on that as well at 95 out of 100. The last thing is the earnings predictability, which measures the company's earnings and how easy or hard they are, or difficult they are to forecast. Once again, Intuit scores well on that at 80 out of 100. And again, there's companies that have, or as low as 5. There's companies as high as 100. But I just want to point out also that earnings predictability and stock price stability don't always go hand in hand. In this particular instance, they do. But I've seen companies that have earnings that are pretty predictable. The stock price isn't as predictable, so to speak, and the stability isn't as high. So I just wanted to point that out. They don't always go hand in hand, but generally it's obviously better for conservative investors to have a higher price stability rating, and that usually means that earnings are more predictable. There's fewer surprises. Thank you.
Yeah, I would add on to that in Intuit's case, it served them quite well when the lockdown and the COVID pandemic over the past 2 years caused issues with regard to the government tax collection season, and obviously that is a big quarter for them, the April quarter, and they had to kind of guide the street as to how the filings were going because the extension occurred well into the summer, and the earnings estimates that are typically very predictable, and their business is usually quite steady. They had to manage those expectations, and the fact that the price stability held at a very high level, I think, was definitely a testament to the safety of the stock, and the earnings predictability remained relatively high despite the complications from the tax extension. Another question I received was about the valuation and how to look at it in the P/E ratio. In the case of Intuit, obviously it has a very high P/E ratio relative to the market, which I believe right now is approximately 19 to 20 times earnings within our in our universe of stocks in the survey, and they have a non-GAAP earnings page. I don't know if you can scroll up there, Alan. Thank you. Right now, there's a pretty big difference between their GAAP earnings that are probably going to be around $7 per share and the non-GAAP earnings that are about $11 per share. Now, this is very well known to Wall Street and the investment community. As you can see, their multiple has gotten relatively high, up into the high 30s. As of last year, you can see the 2021 relative multiple exceeding 2.00 for the relative multiple in 2021. That has come down a bit. However, they generate an enormous amount of cash flow, and the free cash flow conversion relative to the income that they generate is rather large. And so because of the cash flow that they can produce, they are given a very rich valuation by Wall Street, and we look for that to continue, although 3 to 5 years hence, we do think that the relative valuation will be about 1.85, leading to a PE ratio of about 33.5, which is basically in the range that it was in between 2018 and 2020. So I just thought that was a good item to point out. Alan?
Thank you, Charlie. A couple other interesting questions came up, and to piggyback off what Charlie said about the high PE ratio, or I guess relatively high PE ratio relative to the overall market, that it definitely is true. But like Charlie said, there's a lot to back that up, and that's what makes the earnings. The stock price stability that much more impressive, being that it is a higher PE stock. The higher PE stocks generally tend to be a little more volatile, because there is that expectation, built into the higher PE. But in this case, it still has a good price stability rating. So I just wanted to point that out. And on a separate note, we talked about some of the acquisitions the company has made, and one of them being Credit Karma. And as Charlie alluded to, the company does have a strong cash position, a very strong balance sheet overall with not much debt. That begs us to ask, are further acquisitions likely down the road? And, yes, I would say they probably are. But, I just wanted to note that we don't include those in our forecast until they're actually consummated. That's the Value Line convention, because it's very difficult to gauge, acquisitions in the future. So until like the ink dries on the closing, so to speak, we don't include it in our presentations. I just wanted to note that. Charlie?
Well, that was about it.